It is the 19th of September. This is the Global View, and I'm Nadine Blaney. Well, the U.S. Federal Reserve cut interest rates by 50 basis points, or 0.5%. Chair Jerome Powell saying the big bang cut reflects a recalibration of policy and an equal balance of risks between full employment and price stability, saying the Fed wants to maintain the current strength in the economy.
We're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection.
FOMC members now expect to cut interest rates between 4.25% and 4.5% by the end of the year, more than they anticipated back in June. Markets are now fully pricing in a cut of at least 25 basis points at the next meeting, with a roughly 35% chance for another 50 basis point cut. When asked about the decision drawing one dissenter from Federal Reserve Governor Michelle Bowman, who favored a 25 basis point cut, Jerome Powell said all 19 members now expect multiple cuts by the end of the year, which is a big change since June. Well, given chances for a 50 basis point cut was nearly 50-50 heading into the decision, some question whether the big bang cut means the Fed sees a big slowdown in the U.S. economy on the horizon.
We don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. We come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%.
With Jerome Powell reiterating the Fed's apolitical stance ahead of Americans heading to the poll at November 5th, saying that the only mandate for the Fed is maximum employment and price stability. The U.S. stocks closed slightly lower in choppy trade. The market shot up 1% immediately after that outsized 50 basis point cut, but paired those gains once the Fed chair began speaking. So the Dow and S&P 500 did hit intraday highs before weakening. Small cap stocks moved higher, but again, sort of paired those losses by the end of the session. The retailers did well. Dollar Tree's Bath & Body Works were amongst the best performers on the S&P 500. Walmart and Target also ended higher, although some of those gains were paired. ResMed, Albemarle, and T-Mobile were amongst the biggest losers on the S&P 500. Shares of U.S. chip makers initially rose after the Fed cut, but ultimately ended lower. Gold miners also initially rose before tracking the price of the precious metal lower, with Newmont at one point as much as 3% higher, though it closed down by about 0.1%. Uranium companies also initially gained as easing interest rates make borrowing costs cheaper, but after being up as much as 6%, they too ended lower. Apple shares were a standout, though, outperforming the broader market as reviews for the iPhone 16 were released. However, JP Morgan analysts pointed to a soft demand cycle. U.S. Treasury yields extended gains. The 10-year hit more than a one-week high of 3.72%. The U.S. dollar gained ground in choppy trading, and the Australian dollar briefly topped 68 U.S. cents, but is now trading at 67.6. Not to be forgotten, the ECB also cut rates for the second time this year, warning economic growth in the Eurozone will be weaker than it had hoped for. President Christine Lagarde saying it is not on a predetermined rate path. It's not pre-committing to any such moves. So to make sense of it all, Ira Epstein from Lynn & Associates is joining us now. Ira, welcome to the program. Thanks for joining us. What do you make of the market reaction to that 50 basis point cut coming from the Fed?
Well, a couple of things. First, the market reaction. You might ask, why are yields climbing? It's the old buy the rumor, or in this case, sell the rumor, buy the fact. and that reversed what they were doing. As for the Fed, there was no getting this right or wrong, but let's understand that. We're going to get the beginning of a cycle of cuts. Whether they were 25 basis points, which is basically staying data dependent, or moving to 50, which I think was the signal that they are now moving ahead of the cycle. That's basically what I think it is. The Fed chair can say all he wants, they're not playing catch up. Nonsense. When asked the question, had they had the changes to the employment numbers before their Fed meeting, would members have voted for a 25 basis point cut? And the answer should have been, and it was, well, we didn't have it. But the real answer would have been probably. So this brings you into line, and any way you want to go with it, it brings the market now into balance. So what you look for now going forward is how often will the cuts happen? And typically expect 25 basis points. In order to get where the medians are, let's assume that in 2025 you want to end up at 3.4, and you end this year at the median number of 4.4. That's only a 100 basis point cut, yet the market thinks the Fed will be more aggressive. Well, if there's 10 meetings a year, you're not going to do a cut at every meeting. Just to give you an idea, you'd have 2.5 basis, 2.5% taken off that. It's not going to happen. So you have to adjust your thinking now. And because the Fed doesn't cut, doesn't mean that they're still not thinking they're on track. They want the data to catch up to them, and that's what's getting ahead of the curve means. The Fed makes a move now to get ahead of the curve, then it waits for the market to catch it, instead of what they've been doing is letting the cash market set the curve, and they've been the one behind. And that's when the Fed chair said, we've been very patient. Others have cut a couple of times. We didn't. That's acknowledging that whether by design or not, they were behind the curve. Now they're there.
Okay, so the conversation now then, Ira, made it clear that this is a very data-dependent Fed still. We'll get another two jobs reports potentially before the next meeting. We'll get inflation as well. So this is now a conversation about 25-50 at each meeting coming up rather than whether or not the Fed will cut?
Only this year, only for the remainder of 2024. They want to get where they think they're right in the balance, all right? That's why I was shaking my head when you say they're only data dependent. They weren't only data dependent today. That's number one. They got ahead of the curve, so I congratulate them on that. This was much needed. But when we get into 2025, and I know we got to get through 2024, you're only looking for 100 basis points from the median number. You're not going to get a cut at every meeting. That's, maybe I didn't say it right, but that's what I'm pointing our listeners to here. You're not going to get that. So that would be too many. So get ready for the catch up in 2024, whether it's two more 25s, a 50 and a 25. As the Fed said, that part of the data will do it. If the Fed thinks they're ahead of the curve, they've got to believe they're ahead of the curve. If they do, 25s are in line. If they think they're behind the curve at all, they'll go 50.
Okay. So as investors, that means that we are keenly watching all the jobs data to figure out where we're sitting in terms of the rising unemployment rate, and some of those metrics that Jerome Powell was pointing to is still remaining quite strong. Still reflective of a pretty healthy labor market overall.
He said that.
Yeah. What do we think? Like, how should our thinking change as investors, Ira, in terms of allocating?
Okay. So first, they are looking for unemployment to end a little higher by the end of the year than where we're at now at 4.2. They're targeting 4.4. So they think the market will be a little weaker in the employment, and they think that their cuts will gradually turn that ship. That's the first thing. Gold should be definitely on your hit list. Retail stocks, especially the TJ Maxx, the Costco's, the Walmarts. Investors are going to have more money in their pocket. That doesn't mean they're going luxury shopping yet, but it certainly means for the consumer staples and some discretionary money, it is there. That's why, as you pointed out at the beginning, those stocks had a bump today. That's the first thing you look at. The chips, for the moment, are out of play. They're not the place to be for the moment, all right? We've got to get a little bit further down this road, and you need broadening in the market. So there'll be an argument with investors now from the advisor side. Should they go with the large caps or should they go with the small caps? I think the safest play is always the large cap early in the cycle. And I know everybody wants to get ahead of the cycle and they'll start buying the Russells. And I can't argue that. I'm just saying if you were to ask me, this is how you weather this storm. And it's not a storm, it's a good storm. The question is where to put your money. And it is not the place to go in right now and just wholesale buying. We're still in the month of September. It traditionally is a down month. If you look at month to date, you're down 0.4%. The average is down 0.55 to 1% in a number of the indices. So we're at the average. If that's the case, October, probably middle, is when the market starts gathering its momentum. And I expect that Santa Claus Powell will be there at the rescue, giving us a series of cuts in November and December, and I think that'll propel the market higher. So you want to get involved. I'd let the dust settle from what just happened. You have the Bank of England tomorrow morning telling you what their monetary policy is. You start tomorrow the Bank of Japan, a 2-day meeting, and we'll find out on Friday what they think. And of course, you've got to pay attention now to the jobs reports, which come out each week, along with in the United States, ADP, the Challenger Gray. You want to see where things are settling in, because that's what the Fed is looking at. And I do not believe the Fed is looking equal at employment and inflation. I think they are very focused on employment and not as focused on the market with an evil look, with another look on where inflation is, because they think that's embedding. It's locking into the downside. When asked the question about rent, that the shelter cost, as we call it, that's the problem area that they're having. They're hopeful it'll come down. I question that, and I question it for this reason. Supplies in short order here in the United States. People that have homes don't want to sell them. They have a 3% mortgage, and as of yesterday, mortgage rates were 6.2%. Pretty hard to want to pay 3% more for a home. So that's keeping the other people out. Now, if rates keep falling by the spring of next year, that's when you probably see that those people might say, oh, okay, so if I pay a little more, I'm getting what I want. I made enough on my home, because supply is not going to show up all of a sudden.
Yeah, okay, that is so interesting. So do not, you need to, investors need to be patient when it comes to that small cap narrative, waiting for Santa Claus Powell. I will not forget that. Ira, thank you so much for joining us today. Really appreciate it.
Thanks for having me.
Take care. Ira Epstein from Lynn & Associates there joining us live. All right, let's get to a bit of an expectation as to what will drive this local market. SPY futures pointing to a drop of about 0.5%. That is tracking U.S. markets lower. We have jobs data due at 11:30 a.m. local time, so looking forward to that one. And of course, I'll be watching ResMed. ResMed got a broker downgrade in the U.S. and it was one of the worst performers on the S&P 500. Now, here I think is a couple of tweets that really, sum up what the market is grappling with right now. So Howard Lutnick on X posting, as I predicted, Fed started cutting. This means the economy is in much worse shape than we all thought. This is a bad sign for the economy heading into November. So very much, a negative take on what happened today. And then you've got Justin Wolfers, who's an economist, saying, here's what gave the Fed room to move. U.S. beat inflation faster and more completely than any other G7 country. And we did so while continuing to grow the economy. So that's the tension that the market will be trying to digest and work out, clearly in the sessions to come as we continue to keep an eye to the data. That is the Global View. We'll take you through the open next.